Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. This is my first for 2013, and I'm delighted to be back. The market rally since Christmas, or actually since well before Christmas, has been based on three things, all of them related to interest rates. The first one, of course, is that dividend yields on stocks have been much more attractive than the yields investors can get from rolling over their term deposits. So as the term deposits mature, they appear to be less attractive, and the yields on stocks such as Telstra and the banks appear to be much more attractive, and so investors start to move across to stocks. It always happens. The second reason, of course, is that in a low interest rate environment, companies can borrow money more cheaply, and that improves their return on equity. In fact, if they can borrow their money at lower than the cost of their equity capital, it makes sense to borrow money instead of raising capital and diluting shareholders. This makes companies more attractive. And thirdly, of course, is that in a lower interest rate environment, or as interest rates are declining, the discount rate that one uses to value companies comes down as well, and that makes the value of a company higher. It makes the value of every asset higher, in fact. So this explains the rally to date. What happens next? Well, to answer this question, we need to turn the stock market off and think about what we do at Montgomery, which is value businesses. Now, anecdotally, I believe consumer sentiment is improving. I've seen this in terms of luxury car sales. I've seen it in terms of boat sales and reports coming back to me about these things. I also know from a friend who is an operator of large shopping centres that tenant turnover has been improving since October. With this in mind, I asked the team to do what we always do, and that is value businesses. Turn the stock market off, don't try and predict where the stock market is going to go, and think about business values. Is there anything cheap in the market right now? I'm going to focus my attention today on retail stocks and banking stocks. I believe from experience that these stocks could run a lot further, but if we're going to buy them, they need to be cheaper than intrinsic value. What I've asked my team to do is something pretty simple. Take analyst consensus earnings estimates and increase them by 10, 15 or 20%. And say to ourselves, well, what if the earnings for retail stocks is much better than analysts are willing to admit? What if credit growth for banks and the increase in the value of their wealth management businesses is much stronger than analysts are willing to admit, and therefore earnings for banks increase by more than the 4 or 5% that analysts are currently predicting? In those scenarios, what would the valuations of those stocks be? And if those valuations are higher, is there anything cheap right now? Well, I'm here to report to you that it appears the stock market gains may have run their course, and some market valuations appear to be well extended. We couldn't find a bank that was good value based on our valuation metrics, and we can't find a retail stock that appears to be a bargain either. So it looks like this particular rally may have run its course. Of course, I could be completely wrong, and as you know, prices and values don't always track on a daily, weekly or monthly basis. But keep those things in mind, and I look forward to seeing you again next week. Keep following us on Twitter and Facebook, and I'll see you next time.